Today, we explore the U.S. futures market, the battleground for serious prop traders. This chapter breaks down how the market works, why it matters, and why understanding it is crucial before you scale or automate your trading. Why futures? Before diving into automation or scaling your strategy across funded accounts, you must understand the market you're trading in. For most U.S. prop firm traders, that market is futures. It's fast-paced, highly liquid, and regulated. But with great opportunity comes great risk. The problem? Most traders fail their evaluations, not because they lack strategy, but because they misunderstand the rules of engagement. This chapter will help you master the market, so you avoid common pitfalls and succeed. Let's understand what is a futures contract. Let's start with the basics. What is a futures contract? It's an agreement to buy or sell an asset at a set price, at a future date. But you're not taking delivery of gold or cattle. You're trading price movement. Key features: standardized contracts, for example, fixed tick sizes, expiry dates, traded primarily on the CME group, cash settled for prop traders. Popular examples: ES, E-mini, S&P 500 NQ, E-mini NASDAQ 100 CL, crude oil GC, gold futures, T, U.S. Treasury notes. How futures differ from Forex or stocks. Futures are different from Forex or stocks in several ways. Here's a quick comparison. Futures trade on regulated exchanges like CME or NYMEX. Forex? It's over-the-counter. Futures have set margin rules, while Forex varies by broker. Futures also have expiry dates. Forex and stocks don't. Tax treatment is more favorable for futures, thanks to Section 1256. Why does this matter for prop trading? Futures offer defined risk, high liquidity, and scalability. Perfect for automated strategies like those powered by Dr. Markets and TradeRx. Meet the U.S. futures ecosystem. The U.S. futures market is vast. At the core is the CME Group. This exchange handles everything from equity indexes to energy, metals, and agriculture. Popular platforms for executing trades include NinjaTrader, Tradovate, and Rhythmic. Prop firms like Apex, TopStep, and Funded Next provide capital in exchange for successful evaluations. The key players: hedge funds, commercial hedgers, retail traders, and market makers. Understanding who's on the other side of your trades can give you a hidden edge. Start from the basics. What moves the futures market? The futures market responds to both scheduled and unscheduled events. Scheduled events include non-farm payrolls or NFP for ES, NQ, ZBFOMC decisions, affecting interest rates and equity indexes CPI and PPI, which drive market movement, inventory reports, especially for energy futures. Unscheduled events like geopolitical shocks, corporate earnings, natural disasters, or supply disruptions. Pro tip: build an event map in your trade plan. Some days are not ideal for automation. Dr. Markets automatically plans for this, adjusting your strategy based on event timing. Let's understand how tick sizes and margins work. Each futures contract has a tick size, which is the smallest price movement. For example, ES, 0.25 points, $12.50 per tick, NQ, 0.25 points, $5,000 per tick, CL, 0.01, $10 per tick, GC, $10,000 per tick. Margins vary based on volatility. Prop firms may impose rules like daily drawdowns or max loss limits. Over-leveraging can be risky, even if it's technically allowed. Let's learn about futures expiration and rollover. Futures contracts expire quarterly: March, June, September, and December. As a trader, you need to watch volume and open interest, roll contracts early to avoid low liquidity, stay clear of trading near expiry. Automation tools like TradeRx handle rollover logic, ensuring your trades are safe during these periods. This is good. Common mistakes futures traders make. Here are some common mistakes: ignoring the economic calendar, trading illiquid contracts, overtrading micros like ES/MEs without a plan, misunderstanding futures versus Forex, sizing positions without understanding margin to max loss ratios, forgetting about rollover deadlines. As a case study, the trader who nailed 9% and still failed. Here's a real-world example. A funded trader hit a 9% profit target in just 4 days trading NQ. But on day 5, CPI data was released. He over-leveraged 3 micros, got slippage, and hit his trailing drawdown. The result? His account was terminated. Had he planned for the event or used automation to control risk, he could have passed the evaluation. Dr. Markets would have flagged the CPI release, capping his trading for that day. Do you know the tools of the trade? To succeed in futures prop trading, you need the right tools. Here's what you need. Economic calendars, for example, Forex Factory or Market Watch, tick and range charts, NinjaTrader for execution, Dr. Markets for planning, TradeRx for automated execution, and Risk Protection, a trade journal and equity curve analyzer. In summary, futures trading isn't just about buying and selling contracts. It's a system, one that requires understanding margin, liquidity, tick values, and event risks. Automation can help, but only if you respect the market and build systems with purpose.